The Matrix book is a unique tool for seeing decades of history and telling stories about investing that help put recent events in context. We can look at the long-term positive return of stocks as well as shorter periods of negative returns to demonstrate some of the uncertainty of owning stocks. The S&P 500 index represents a substantial portion of the U.S. stock market. The index has a long data history going all the way back to 1926, which can help us put current events into the larger context. The matrix here shows many positive returns in black and some areas of negative returns in red. From 1926 all the way to 2017, the S&P 500 has given an annual compound rate of return of 10.2%. Now, given this, what is the probability of a positive return or a negative return, say this year or next? Well, while we can't answer that with certainty, we do know from the last 92 years of available history, 24 of those years had a negative return. In other words, about 26% of the time. Stated another way, approximately 3 out of 4 years in the past have generated a positive return. What if we examine stock returns over periods, say, greater than 1 year? Moving down the diagonal helps us see rolling returns over longer periods. So for example, the numbers highlighted below show that rolling 10-year periods have been positive over 90% of the time. Now, while we expect stocks to earn a positive return over the long term, even over 10-year periods, the S&P 500 index has in fact experienced negative returns. Now, the period from 2000 to 2009, often referred to as the lost decade by U.S. equity investors, and over that 10-year period, the S&P 500 index had an annualized rate of return of minus 0.9%. To say it another way, an investor who put $1 million in the S&P 500 index fund at the start of that decade had approximately $910,000 left at the very end of 2009. Now, is there a less volatile option that minimizes these ups and downs? 1-month U.S. Treasury bills would be one of those options. Like the S&P 500, T-bills have had a long data history. Over those 92 years, we do not see a single annual return in red. There is a trade-off, however. T-bill returns over the last several years have been right near zero per year. From 1926 to 2017, T-bills had an annualized rate of return of 3.4%, while the S&P 500 returned 10.2%. Now, the lesson is that most investors may prefer to have some of their allocation into equities, not just bonds, in order to grow their long-term wealth.